If tomorrow morning the United States announced that it was going to pay off every dollar of its national debt, most people would cheer. Headlines would celebrate. Politicians would call it historic. Economists would praise the discipline. But behind closed doors, markets would panic, pensions would wobble, banks would freeze, and the global financial system would start cracking in places most people never even knew existed. Because here's the uncomfortable truth that almost nobody tells you. In the modern world, national debt isn't just a burden. It's a load-bearing pillar. Remove it too fast, and the entire structure starts to collapse. Welcome to Cash Historian. Today we're diving into a paradox that sounds insane at first, but makes disturbing sense once you see how the system actually works. Why paying off national debt, especially in countries like the United States and Canada, wouldn't save the economy but could instead break it. To understand why, we need to unlearn something that feels morally obvious. In everyday life, debt is bad. You work, you earn, you pay off what you owe, and freedom follows. That logic works for households. It even works for small businesses. They live inside systems built on promises, confidence, and circulation. And those systems evolved over more than a century in ways that quietly flipped common sense upside down. After the Revolutionary War, the young nation carried heavy obligations. But leaders like Alexander Hamilton believed debt should be managed carefully and retired over time. By the 1830s, Andrew Jackson had eliminated the national debt entirely, the only time in American history that's ever happened. At the time, it was celebrated as a triumph of responsibility, but even then something strange followed. Credit tightened, banks failed. A severe depression hit shortly afterward. The connection wasn't fully understood then, but it left a quiet lesson behind. Removing government debt also removed something else the economy depended on. That dependency grew dramatically in the 20th century. The creation of the Federal Reserve in 1913 changed the role of debt forever. Instead of being a temporary emergency tool, government borrowing became a permanent instrument of economic management. During World War I and then World War II, the U.S. government issued massive amounts of debt to fund survival. This time, instead of aggressively paying it all down afterward, the country discovered something new. Debt could be rolled over. Old bonds could be replaced with new ones. Interest could be serviced without eliminating the principal. And the economy didn't just survive, it grew. After World War II, the United States emerged as the center of global finance. The dollar became the world's reserve currency. Other nations held U.S. debt not because America was weak, but because it was strong. Treasury bonds were safe, liquid, and predictable. They became the backbone of pensions, insurance funds, and banking systems not just in the U.S., but across Canada, Europe, and much of the developed world. At that moment, debt stopped being just an obligation. It became a product. The real turning point came in 1971, when the U.S. ended the gold standard. From that day forward, government debt was no longer constrained by physical reserves. It was constrained by confidence. As long as people believed the U.S. would honor its obligations, the system could expand. And expand it did. Deficits became normal. Debt ceilings became political theater. And the idea of fully paying off the national debt quietly faded from serious policy discussion. Here's where the cause and effect becomes critical. Government debt isn't just money the state owes. It is also money someone else owns. Treasury bonds are assets. They sit on balance sheets. Banks use them as collateral. Pension funds rely on them for steady returns. Central banks use them to control interest rates. If you remove those assets suddenly, you don't create freedom. You create a vacuum. This became painfully clear during the 2008 financial crisis. When private debt collapsed, governments stepped in and issued more public debt to stabilize the system. Central banks, including the Federal Reserve and the Bank of Canada, began buying massive amounts of government bonds. This wasn't just stimulus, it was structural support. By the mid-2020s, central banks were among the largest holders of their own government's debt, not as a conspiracy but as a necessity. Without that demand, bond markets would have seized up, and borrowing costs would have exploded. At the same time, another hidden pillar of government debt grew quietly: intra-governmental debt. In the United States, programs like Social Security and Medicare collect payroll taxes and invest the surplus in special Treasury bonds. These bonds are assets to the trust funds, but liabilities to the Treasury. That means the government owes money to itself on behalf of future retirees. In Canada, the structure is different, but the effect is similar. Public pensions and government-backed funds depend heavily on sovereign debt markets remaining stable and liquid. Now imagine what paying off the national debt would actually mean in this context. To eliminate the debt, the government would have to either raise enormous amounts of tax revenue, slash spending dramatically, or inflate the currency to reduce the real value of what it owes. Each option creates hawk waves. If taxes were raised enough to pay off trillions in debt, consumption would collapse. Businesses would pull back, unemployment would spike. Pension contributions would fall just as trust funds needed liquidity. If spending were cut aggressively, the damage would be immediate. Social Security, Medicare, defense infrastructure, and public employment all depend on steady government outlays. Removing them at scale would trigger a deep recession or worse. What about inflation? In theory, governments could inflate away their debt by reducing its real value. But inflation doesn't erase obligations evenly. It punishes savers, retirees, and wage earners while rewarding debtors and asset holders. In both the U.S. and Canada, inflation in the early 2020s already showed how politically explosive this path can be. Housing costs soared, grocery bills jumped, trust eroded. Pushing inflation further to wipe out debt would risk social instability long before the balance sheet ever hit zero. There's also the question of the bond market itself. U.S. Treasury bonds are the foundation of global finance. They are used as collateral in overnight lending markets. They anchor interest rates for mortgages, car loans, and business credit. Canadian government bonds play a similar role domestically. Paying off the debt would shrink this market dramatically. Less supply of safe assets would force investors into riskier alternatives. Volatility would rise. Financial institutions would struggle to meet regulatory requirements that assume government bonds exist in abundance. This is why the idea of just paying it off never survives contact with reality. The debt isn't sitting in a vault waiting to be erased. It's woven into contracts, retirement plans, and financial plumbing at every level. Remove it, and the system doesn't breathe easier. It gasps. By 2025, the United States carries over $38 trillion in federal debt. Canada carries over 1.4 trillion Canadian dollars. In both countries, interest payments are consuming a growing share of government budgets. In the U.S., interest costs are now rivaling or exceeding national defense spending. This sounds like a warning sign, and it is. But it's also evidence of dependency. The system has grown around the debt. It feeds on it. Every few years, debt ceiling fights erupt in Washington. Politicians warn of catastrophe. Markets hold their breath. Then, at the last moment, the ceiling is raised. Critics call it irresponsible. Supporters call it necessary. In reality, it's neither. It's inevitable. Defaulting or rapidly paying down debt would be more destabilizing than continuing the cycle. The choice isn't between good and bad. It's between bad and worse. Canada faces a quieter version of the same dilemma. Without a formal debt ceiling, the pressure shows up elsewhere. Housing bubbles fueled by low rates. Young workers priced out of ownership. Government reliance on continued growth to service obligations. The Bank of Canada, like the Fed, walks a tightrope between controlling inflation and protecting a debt-heavy economy from shock. This leads to the deepest paradox of all. Governments warn citizens about debt while building systems that cannot function without it. Debt becomes permanent not because leaders are reckless, but because the alternative threatens everything built on top of it. So when people ask, why don't we just pay it off? The honest answer is unsettling. Because paying it off would collapse the very institutions that make modern life stable. Pensions, banks, insurance systems, and even basic credit markets assume the presence of government debt. It's the quiet anchor holding the ship steady in rough waters. That doesn't mean unlimited debt is harmless. Far from it. Excessive borrowing carries real costs. Inflation, inequality, reduced future flexibility, and political tension all rise as debt grows. But elimination isn't the cure people imagine. The system wasn't designed to end cleanly. It was designed to roll forward. That brings us to the uncomfortable lessons we need to take away from all of this. First takeaway. National debt in modern economies is not just a liability. It is also a critical asset. Remove it too fast and you don't free the economy. You destabilize it. Second takeaway. Central banks are not neutral spectators. They are active managers of debt-based systems, constantly balancing inflation, growth, and financial stability. Their role makes paying off debt structurally unlikely. Third takeaway. The real risk is not sudden collapse, but slow erosion. Purchasing power, opportunity, and trust decline gradually when debt grows faster than the real economy. So here's the question to sit with. If paying off national debt would collapse everything, what does that say about the system we've built? And more importantly, how long can it keep rolling forward before the cost becomes too high to ignore? This is Cash Historian. If this video changed how you think about debt, money, and the stories we're told, like the video, subscribe to Cash Historian for more deep dives into financial history and hidden systems. And share this with someone who still believes the national debt is just a big credit card bill. On the end screen, you'll see the subscribe button and a prompt asking what you think happens when confidence finally breaks. Because in the world of money, the most dangerous truths are the ones that sound like common sense until you look closer.